Hello. In this video, we'll discuss the most common mortgage terms you will hear in the mortgage industry and the different types of mortgages the borrowers can secure to get their dream home. By the end of this video, you will be able to show basic understanding of the mortgage industry. So what is a mortgage? A mortgage is a type of loan used to buy a home. It involves a legal agreement where the borrower receives money from a lender to purchase property and agrees to pay back the loan over time, usually with interest. The property itself serves as collateral, meaning if the borrower fails to repay the loan, the lender can take ownership of the property. In addition to knowing what a mortgage is, there are also lots of key mortgage terms that get used that you will need to know. Some of these terms include: a lender is an organization or person that lends money with the expectation that it will be repaid, generally with interest. A borrower is a person who applies for, receives a loan, and must repay it. A down payment is a portion of the price of a home, usually between 3 to 20%, that is paid upfront and not included in the loan. The loan amount is the total sum of money that a borrower agrees to repay to the lender. The loan term is the length of time over which the borrower agrees to repay the loan. The interest rate is the cost the borrower will pay each year of the loan term to borrow the money, expressed as a percentage. Fannie Mae and Freddie Mac are government-sponsored enterprises that expand the secondary mortgage market. They securitize and facilitate the buying and selling of mortgages, allowing lenders to reinvest their assets into new loans. This process helps increase the availability and affordability of mortgage credit. Mortgage insurance is an insurance policy that partially compensates the lender for losses if the borrower cannot pay them back. Loan-to-value, the LTV ratio, is a crucial metric for assessing the risk associated with a mortgage loan. Higher LTV ratios indicate higher risk for lenders, necessitating additional measures such as mortgage insurance to mitigate potential losses. Debt-to-income ratio is used by lenders to determine a borrower's ability to manage monthly payments and repay debts. Now that we have more information about the basics of a mortgage, let's discuss how the borrower can get a mortgage. To obtain a mortgage, the borrower must first complete a loan application that is then reviewed to determine eligibility. If approved, they enter a legal agreement with the property serving as collateral. Borrowers can also lock in an interest rate when applying. The borrower makes regular payments, typically monthly, and receives mortgage statements throughout the loan term. In summary, a mortgage is a secured loan where the property acts as collateral and the borrower repays it over time. Not every borrower has the same financial situation, so therefore, not every mortgage is going to be the same. It is your job to know which mortgage will be the best for the borrower. Available mortgage types include conventional, FHA, USDA, and VA loans. Conventional loans can be either conforming, which means they meet the guidelines set by Fannie Mae and Freddie Mac, or non-conforming, such as jumbo loans, which do not meet these guidelines due to their larger size. An FHA loan is a mortgage insured by the Federal Housing Administration, a federal agency. The FHA provides mortgage insurance to protect lenders from losses if a borrower defaults on the loan. It also sets standards for construction and loan approval. The USDA loan is a mortgage from the United States Department of Agriculture that helps people buy homes in rural areas. These loans do not require a down payment and are aimed at low to moderate income borrowers. They also allow the closing costs and seller contributions to be financed into the loan. The VA loan is a mortgage guaranteed by the U.S. Department of Veterans Affairs, intended for eligible American veterans and their surviving spouses. There are many options that a lender can offer, and it can seem daunting to go through it all, but that is why your lender is here to help. In this video, we reviewed the most common terms in the mortgage industry and the different types of mortgages borrowers can use to secure their dream home. You will now be able to show a basic understanding of the mortgage industry. If you have any questions, please reach out to your account executive. Thanks for watching.